Good morning, I'm Adam Davis.
And I'm Tanaka.
And we're making millions over morning coffee. Well, interest rates over the last couple weeks have been relatively stable, which is a good thing. Something that triggered the foreclosure situation that we're currently enjoying as real estate investors and homeowners that are out there purchasing second homes and rental properties to try to make up for some lost equity, know that interest rates were part of what caused the problem in the first place in the foreclosure market, because adjustable rate mortgages function based on underlying interest rates. So if an underlying interest rate goes up, the payment on that mortgage is going to get recalculated after that set period of time, and it's going to go up, so the housing payment is going to go up accordingly. Now, some staggering numbers just came across my desk that I want to share with you. That is that adjustable rate mortgages are currently accounting for 42% of foreclosures. That's right, adjustable rate mortgages account for 42% of the foreclosures in the marketplace right now. Fixed rate mortgages, or more traditional mortgages, account for just 18% of the total foreclosures in the marketplace right now. So what does that tell us as investors and entrepreneurs? That tells us that certain borrowing characteristics lead to this houses that are becoming available for us at pennies on the dollar. And to me, stable interest rates are going to start to stem the tide of these foreclosures and start the turnaround in the marketplace that's going to help pick us up in the next couple years.
Yeah, the interest rates right now that are going through the roof, unfortunately for Michigan residents and other Americans, there's just no stopping them. They signed a mortgage 2 or 3 years, maybe 5 years ago, and it said right down in the tiny little print that they didn't understand, which is unfortunately their own fault, that their mortgage was going to climb from $600 a month to $1,100 a month all of a sudden. So what's the average person supposed to do? They're overextended on car payments, they have too many credit card payments, and they just really haven't planned right for the future. And that's a little bit about what we're going to talk about today, is why you have to be careful with your finances.
Exactly, Dylan. Being careful with your finances, being prudent, good stewardship, good management, call it whatever you will. But the bottom line is that most Americans run their lives on the edge of disaster all the time. And the thing is that people read this a lot. They read this in Time Magazine, they read it in Newsweek, they read it in the Wall Street Journal, you hear it on CNN, you hear it on Fox News, you hear it on your local news. You hear it everywhere that Americans have a lot of credit card debt, a lot of consumer debt, student loan debt, car loans, car leases, housing payments, first mortgages, second mortgages, home equity lines of credit, in-store credit cards. I mean, the debt pool goes on and on. To me, this is a phenomenon that's explained by one reason. Some people want to point to the fact that America is a consumption nation, that the basis of the American economy is consumption. And I think that that's part of it, that we do have a consumer culture here. I think another big part of it is that over the last probably 10 years or so, interest rates in the federal government have been kept extremely low. The federal government, the Federal Reserve, the government, the United States Treasury has flooded the market with dollars in order to finance things like war efforts. Now, this is not a political show, but the bottom line is if you have an expenditure, you need to pay for that expenditure. So if you're a company, you need to buy a plant, you have to get a loan to buy the plant. If you're the government, you need to finance tanks, you have to get a loan to finance the tanks. That's just basic economics. But the bottom line is that the government of the United States, and they're not solely to blame because there are market forces here, has effectively penalized savers. So when we look at there being a negative savings rate in America since 2005, why is that? Is it just because we're such a consumption nation, or is it because the policies, the fiscal and monetary policies of the United States encourage consumption and discourage savings? They encourage consumers to live close to the edge, to walk that fine line between foreclosure and staying in the home, between losing the car and driving the car to work the next day. And that's a big part of why we're looking at such a gold mine as real estate investors right now in Michigan.
Yeah, Adam, unfortunately, the way to look at it is when you own a big company and you have a bunch of employees, you can't pay them too much money or they're going to leave you and start their own companies. And I think you can kind of translate that into America itself, because the government effectively, which I love America, so don't take this wrong, but the government has effectively figured out how to tax us to the point where we are riding close to the line, And then we go to Best Buy and buy a big screen TV. And then the next week buy another car, and then the next week you're looking at a cottage up north. So like Adam said earlier, you have to be prudent with your finances, and if you are, the opportunity right now in Michigan real estate is just staggering. We just had a friend of ours come in the office this morning, and he builds $1 million houses. He builds houses with bulletproof windows and safe rooms even. That's how awesome these houses are. I've been in one of them, just amazing. Well, he's not retired, but he is retired from building at this point, and he started buying houses for $30,000, $40,000, $50,000, rehabbing them because he's a builder and he has the crews to do that, and he's making $10,000, $15,000, sometimes $25,000 per transaction when he sells them, because he was intelligent enough to see that new housing starts were down. He pays attention to what's going on in the economy, and he said, how can I make money in this down market? So he has effectively probably made more money in the last year than he did in the year before while doing business with $25,000 to $50,000 houses as opposed to $1 million homes.
It's a great point that Dylan makes about looking at something that could be potentially be a liability for you. New housing starts could be a liability for a home builder. And by looking at the economy, looking at what the market's giving you, you can go ahead and flip that around and make it a chance for yourself to triple or quadruple your net worth in a very short period of time. While everybody else has their head stuck in the sand, you're up there looking for opportunities. Now, what do all these things mean for investors? How should you manage your personal finances so that you can stay away from where the average consumer is, which is right along that line close to the margin, and step closer and closer to the wealthy Americans that are really getting richer and richer in this marketplace? They always say that the rich get richer and the poor get poorer. You have a decision. You can decide which side of that line you'd like to be on. In terms of managing your finances or managing your business as an investor, it comes down to the basic fundamental concepts that you learn from books like The Richest Man in Babylon, Think and Grow Rich, The Automatic Millionaire, prudent financial principles. Eliminating consumer debt or staying away from consumer debt, paying cash for things. Some of the wealthiest investors we know pay cash for literally everything. Take all the financial theories out that say you're supposed to leverage and capital allocate till the cows come home. Crumple that up and throw it away. Because we're not talking about theory. We're talking about practical things that you can use in your business and wealth building principles that the richest investors that we know, guys that have $50, $60 million net worths, what do? They pay cash for their cars. They pay cash when they buy houses. They're very careful with how much debt they put on a house. They manage their personal cash flow properly. They pay cash for vacations. You don't see them riding around in the fanciest cars all the time. Why? We live in Michigan, so you only get to see that car probably 3 or 4 months out of the year. But just basic discipline and being studious of where your personal finances are, and keeping to this golden rule with investing is that if everybody else is doing one thing, which means if all the other American consumers are doing one thing and running up debt and credit card debt, then you need to be doing the exact opposite.
Exactly, Adam. I agree 100%. I'd like to touch on a principle from the book written by George S. Clason, which is The Richest Man in Babylon. And if I have one tip for everyone out there today who's listening and watching, whether you're a homeowner or you are an investor, try to finance your homes over 15 years instead of 30. Play around with some amortization tables. Go to Yahoo Finance or Bankrate.com. Look at a $100,000 house. Look what you're going to pay for it if you pay it off by the year 2023, as opposed to if you pay it off by the year 2038. You're going to pay 3 times for that home on a 30-year mortgage. And because the rates are so low right now, especially for investors, you should be amortizing your loans over 15 years.
If you can, that's great cash management. You're going to pay your house off a lot sooner. And let's face it, 30-year mortgages are invented to make banks rich and not you rich. So if you're looking at a cash flow situation on investment property, if you can cash flow on the 15, which you can in this market, do it with your personal residence. Personal debt is bad. It's the enemy of wealth. Start making changes today.